important announcement which led to volatility and a lot of confusion in the bond market was the announcement by RBI of variable rate reverse repo auctions, under which RBI basically absorbs liquidity from the interbank market. So RBI announced a VRRR of about 1 lakh crores, out of which about 86,000 crores was tendered in the auction, the rate and which came at 649. Why it was important for the market was uh, because of very high liquidity in the interbank market. So right now, interbank liquidity is around 2.5 trillion rupees, due to which the actual, the tri-party rate or the call rates are even lower than the SDF rate. So since the policy rate is at 5.5, the SDF rate is at 5.25, the actual tri-party or the secured funding rate in the economy is even lower than 5.25. Since the market is pricing its whole money market curve, uh, at less than 5.25, because if your overnight rate is, let's say, close to 5.15, 5.20, your T-bill rates, your CDCP rates, and your bond market rates price accordingly. The announcement, uh, of VRRR by some market participants was seen as probably a reaction from RBI to move the interbank rate close to the policy rate of 5.5. So in a way, an effective tightening of 30 basis points. And of course, if the overnight rate is being tightened by 30 to 35 basis points, it also leads a corresponding impact on other asset classes as well. Through this chart, what we have tried to analyze is the previous VRRR auctions and whether they have impacted overnight rate. What we have really seen previously, even during 2022 when the liquidity was abundant and RBI was absorbing liquidity through VRRR, largely the objective of VRRR was to stabilize the market. So, like I said in the beginning, currently the interbank liquidity is running at about 2.5 lakh crores. If we add in the government cash balance, the total system liquidity or the core liquidity is around 5.5 lakh crores. If you look at the CRR cut, which the RBI has announced, which adds to about 2.5 lakh crores from September to December. So even if, let's say, there is a maturity in RBI FX book, which right now RBI is running short by about $65 billion. Even if RBI, provides delivery of some of its forwards, the liquidity is expected to remain ample at least for the next 12 months. If the RBI had not announced the VRRR, the overnight rates had even gone probably below 510. So we do not really see the announcement of VRRR as an attempt to tighten liquidity. We do not see the announcement of VRRR as an announcement or a view on or a measure by RBI to give a yield signal to the market. We largely view the announcement of VRRR as normalization of liquidity. Liquidity is quite ample. In fact, in next 2 3 months, liquidity could even increase as government spending picks up, and that is why probably RBI announced, the 1 lakh crore VRRR to ensure the rates remain stable. In fact, even after the announcement of this 1 lakh crores of VRRR, the overnight rate, especially as indicated by the tri-party or TRIPS rate, they are still below the SDF rate, which is 5.25. So broadly, there is no impact on the money market rate curve because of the VRRR option. Of course, we'll have to see and watch out this space whether RBI continues to upsize the VRRR or whether they start to gradually um, increase the frequency of VRRRs, from 7 day to 3 day or 1 day, which could give a proper yield signal to the market that probably RBI wants to hike overnight rates. But at least for now, we do not think that's the case. We just think that RBI is fine tuning liquidity, is just ensuring that the liquidity remains close to at least the SDF rate, if not the policy rate.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.